when you meet some entrepreneurs, they tell you they want to raise money. They tell you they want to raise $100,000. They just want money. You then ask them, what kind of money are you looking for? What kind of capital? They tell you they just need $100,000. It doesn't matter. So, do you want it as a loan? Do you want it as equity? Or do you want it as a hybrid? Of course, do you want it as a grant, free money? I know most people default to free money. But the problem with grants, the problem with free money is that everybody wants it. And as a result, there's a lot of competition for grants. So it's either, so the question is, do you want to spend more time running your business, or do you want to spend more time chasing grants? Because it can be a very absorbing process. So it's either you're running your business, or you're running after grants, because everybody's running after grants. So if we're being serious, let's just keep grants. Grants are 50-50. If you're lucky, you may get them. So let's talk about the options that you control. Should it be a loan? Your lenders will not want to hear stories from you. They want to be sure that you can pay back, which explains why banks do not really give money to startups. No matter how beautiful your business plan is, banks are not in the business of funding startups. Banks are in the business of funding cash flow businesses. So if you look at a typical bank loan, they want to see the activity on your bank account. They want to see that you have transaction volume. That tells them that there is cash flow. Then based on that cash flow, they will compute how much they can give you as a loan based on how much your business can pay back on a monthly basis. So that's what banks do, because they are into loans. Loans thrive on cash flow. So no matter no matter the potential of your business, no matter the return you promise them, a bank will not give you money except there is proof of cash flow. So if you don't have cash flow, don't go near a bank. Don't even touch a loan. I will also talk about the reverse, because in my line of work, I typically work with the two sides. On some transactions, I'm on the entrepreneur side. On some transactions, I'm on the investor side. So I see the two worlds and I know what the two parties are looking at. And I always encourage entrepreneurs, anytime I'm talking to business owners, don't be too selfish. Most entrepreneurs I want money, I want to raise money. They're not thinking about the investor side. If you put yourself in the shoes of a potential investor, you will save yourself from a lot of traps that entrepreneurs typically fall into. So that's it for a loan from the entrepreneur side. For equity, what equity means, unlike a loan means I'm giving you this money. I'm giving you this $100,000. I'm giving you this 100 million naira. Whether your business works or it doesn't work, you must pay back that money. That's what a loan is. Whether you make money or you don't make money, we don't care. You must pay back that money. The bank doesn't want a seat on your board of directors. The bank is not going to give you coaching or give you advice. You cannot go to the bank and say, I'm having trouble with sales. I'm having trouble with suppliers, trouble with distributors. Can you help me? The bank doesn't do that. That's not part of their business. A loan is an obligation. Obligation means it is compulsory. Whether you have made money or not, whether the business works or not, you must pay back the money. That's how a loan works. But equity is a different beast. What equity means is that the person giving you the capital is going to share risk with you. So when it comes to equity, the only way the investor will make money is if you make money. So while a loan is whether you make money or you don't make money, you must pay back the loan. That's what a loan is. Equity is I only make money if you make money. So the investor only makes money if you, as the entrepreneur and the business, makes money. So you are sharing risk. But then what it means is that because of the risk that the investor is sharing with you, the investor wants more. I see some entrepreneurs and business owners that are shocked when the investor tells them, oh, you want to raise $100,000. I want 60% of your company. I want 55% of your company. And you're like, how? That means you're going to control my company. Yes. And this pushes us to another problem. Why would you go to raise money without having an idea of the valuation of your business? Because I hope you understand that if you're asking an investor for $100,000 and the investor says, I want 50% of your business, the investor has valued your company at $200,000. Half of 200,000 is 100,000. So if I give you 100,000, you must give me 50%. Or no, you have to give me 50% of your company. So the problem is that entrepreneurs go into these meetings unprepared. They go to meet investors unprepared. So all they know is they want to raise money. They want to raise $100,000. But at what valuation? Do you have a credible basis for your valuation so that when the investor tells you how much equity they want, you can counter them?